Chapter 1, Introduction to Forex Markets. Section 3, Why Currencies Move. Currencies don't really move on their own. In a pair like Euros/USD, the price is always comparing two stories at once, so traders are constantly weighing how the outlook for Europe stacks up against the outlook for the United States. Most exchange rate moves come back to three broad forces: interest rates, economic data, and market sentiment. Sometimes those forces all point in the same direction and create a strong move, and sometimes they pull against each other and leave the market choppy. Over longer periods, interest rate differences are often the biggest driver in Forex. If one country is expected to offer higher yields, money may flow toward that currency, and importantly, markets often react to central bank signals well before an actual rate decision arrives. Economic reports matter, but the real spark is surprise. If jobs, inflation, or growth come in much stronger or weaker than expected, traders quickly rethink what central banks might do next, and bigger surprises often lead to bigger currency moves. Not every move needs a scheduled report behind it. Changes in confidence, headlines, stock market direction, and volatility can shift risk appetite fast, pushing money toward growth-sensitive currencies in calm periods or toward safer currencies when fear rises. Some of the sharpest moves happen when markets are hit by something unexpected. Elections, trade disputes, conflicts, sanctions, or natural disasters can all force traders to rapidly reprice risk, and that uncertainty often shows up as much higher volatility. It helps to separate short-term catalysts from long-term drivers. A headline or data release can create a quick spike over minutes or hours, but lasting trends usually need broader support from interest rates, inflation, growth, and policy differences between economies. When a major report hits, the market usually follows a chain reaction. Traders compare the number to the forecast, update their policy expectations, place orders quickly, and then reassess the details, which is why the first move can either extend or reverse. Take USD SAID as an example. If Canadian jobs data comes in much stronger than expected while US data is simply in line, the bigger surprise is on the Canadian side, and that relative shift can send USD SAID TAD lower even without weak US numbers. Forex price changes can look tiny, but they can still matter a lot. A move of just a few pips becomes much more important when leverage is involved, and around major releases, fast conditions, wider spreads, and slippage make risk control especially important. A practical habit is to plan the reaction before the release happens. Pick one US report and one Euro area report. Note the current Euro/USD price, and write down what outcomes would push the pair up or down. Then compare your plan with how the market actually responds.